Welcome to the Deep Dive. We're here to cut through the noise on complex topics, and today, well, we're diving into something pretty fascinating. Shariah screening for investments. It's where finance meets faith.
It really is.
For anyone not familiar, Shariah is Islamic law, and it covers, all aspects of life, including finance. So our mission today, we want to peel back the layers, using your sources, figure out what really makes an investment Shariah compliant, look at the key criteria, and maybe uncover a few surprises along the way.
Yeah, it's definitely a specific area and often misunderstood. Getting these precise rules clear as well, it's really crucial for investors trying to navigate this unique landscape. It ensures their portfolios align with their beliefs.
Okay, so let's unpack this then. What exactly is Shariah screening, fundamentally?
Well, it's essentially a process, right? A dynamic one.
Right, a process to see if investing in a specific company's stock is permissible under Shariah principles.
Right.
And it uses specific criteria, guides Islamic investors. Your sources say a stock has to pass two main types of screens, sector-based and financial ones.
That's the core of it, yes. And the why behind it all is rooted in faith, you see.
Yeah.
It lets investors manage their money in a way that fits their religious convictions. So it's much more than just numbers. It's principled. It's about integrating values.
Makes sense. So to break it down, we can think of it in like three main stages or pillars.
That's a good way to put it, in a multi-layered approach.
Right, a structured way to ensure compliance. So first there's business sector screening, then financial ratio screening, and finally something called dividend purification.
Those are the three key steps.
Okay, so let's tackle that first filter, business sector screening. What kind of businesses are just out, completely excluded?
Well, the list is pretty clear from the sources. You're looking at companies involved in alcohol, pork products, tobacco,
Okay.
gambling, pornography, conventional financial services, think interest-based banking, also conventional insurance.
Got it. The sources also mention trading gold and silver on a deferred basis, and even advertising, media, and entertainment.
Yes, those two. But here's where it gets nuanced, and this is really crucial.
Okay.
A company can actually still pass the screen even if it gets a small amount of revenue from these areas. The threshold mentioned is less than 5% of its total revenue.
Interesting. So it's not like zero tolerance.
Exactly, less than 5%, and that includes interest income too. It shows a kind of practical application, It acknowledges that in today's complex business world, tiny involvements might happen. It's flexible, but still principled.
That 5% rule, yeah, that sounds very practical.
Yeah.
Okay, so moving on to the second layer then, financial ratio screening.
Right.
So a company clears the business type check, now its books, its accounting ratios get examined.
Precisely. And the big focus here is on leverage, basically, how much debt the company is carrying, and also checking again on that proportion of revenue from any non-compliant activities.
Okay, leverage. So what's the specific rule there?
The main one is the debt ratio. A company's total debt divided by its 36-month average market value of equity. That number must be less than 33%.
Less than 33%. Got it. And how do they define debt for this? Does everything count?
No, and that's key. It's very specific. They focus on interest-bearing debt.
Okay.
So that includes long-term and short-term debt that carries interest. Also, things like the current portion of long-term interest-bearing debt, overdrafts, bridge loans, if they bear interest.
Right.
But and this is important. It excludes things like your everyday operational debts that don't bear interest, like, money owed to suppliers, gratuity provisions. It also excludes Islamic debt and non-interest loans from, say, government bodies.
So it's really targeting that interest component.
Exactly. It aligns with the core principle of avoiding riba, or interest.
And you mentioned the market value calculation even that uses moving averages and adjustments.
Yeah.
Wow. So the level of detail is pretty intense.
It really is. Very meticulous.
Okay, so that brings us to the third level. And this one, dividend purification, seems like it might catch people by surprise.
It sometimes does, yeah.
You'd think, okay, the company passed the business check, passed the financial ratio check.
Right.
We're good.
Well, not quite finished.
Yeah.
Even if a company passes those first two hurdles, if it still gets any income from those non-permissible activities we talked about, even if it's below that 5% threshold,
Yeah.
then the portion of the dividends that comes from that specific income needs to be purified.
Purified. Okay, what does that mean in practice?
It basically means cleansing that portion of the income. Usually this involves calculating the proportion and then giving that amount to charity.
Ah, I see. So you calculate how much of the dividend came from iffy sources and donate it.
Precisely. They calculate what's called the dividend purification ratio, or DP ratio. It's the non-permissible revenue, including any interest income divided by the company's total revenue.
And that non-permissible revenue, that's quite broad then.
Oh, yes. Very comprehensive. It covers all kinds of interest income, from deposits, bonds, money markets, you name it.
Okay.
Also, non-permissible income from other investments like derivatives or certain funds. And of course, revenue from selling alcohol, pork, tobacco, gambling, porn, conventional finance or insurance services, gold and silver on deferred terms.
So basically everything from that first list.
Pretty much. Plus any other income identified as non-permissible. It's thorough.
So give us an example. If the DP ratio is, say, 0.10.
Right, 0.10 or 10%. That means if you receive dividends from that stock, you'd need to give 10% of that dividend amount to charity.
And if this was 1.0.
Then 100% of the dividend needs purification.
Wow. Okay. And these calculations, they're based on the latest company reports.
Yeah.
Annual ones, preferably.
That's right. Latest annual reports are preferred because they're usually audited. But if needed, they'll use detailed quarterly reports or even a prospectus. It's about using the best available data. It's a real commitment, even after you've invested.
It really is.
Yeah.
So with all these complex rules, who actually does all this screening? How does it work in practice? That leads us to firms like Islamicly, right? They streamline this.
Exactly. Companies like Islamicly specialize in this.
And what makes their approach stand out, according to your sources? They mention an in-house Shariah advisory board.
Yes, having their own board provides direct guidance. And they offer a real-time, pre-screened list of stocks updated daily.
And here's something I found really interesting. The sources say they have a dedicated research team that manually reviews business sectors.
Mm-hmm. That human review element is emphasized. They manually check the business activities and identify those non-permissible revenues to get the compliance status right. They mentioned drawing on, over 20 years of experience?
Yeah, over 20 years. That's quite something.
And related to that, the sources also clarify how they use financial results. They use the latest statement available but prefer annual audited ones for completeness. Which actually brings up an interesting point. Are there companies that are just considered compliant automatically? Like they don't need all these ratio checks?
That's a great question. I was wondering the same thing. And yes, apparently there are.
Ah, okay.
Your sources say that companies deemed fully Shariah compliant don't need these accounting-based screens. But crucially, this requires approval from a Shariah board.
I see. So what makes a company fully compliant then?
It seems to boil down to a few things. They need to have their own Shariah supervisory board actively overseeing things. All their transactions, business and financial, must already adhere to Shariah principles. And the company itself needs to be set up and managed in a fully Shariah compliant way from the start.
So it's like compliance is built into their DNA from the ground up.
Exactly, a holistic approach. So if we put it all together, the process at a place like Islamicly starts with their big database of stocks.
Mm-hmm.
Then it goes through their Shariah committee. Then the research team does the deep dive qualitative fundamental analysis, looking at websites, reports, filings.
All that groundwork.
Right. And the result is that daily list of compliant stocks that individual DIY investors can then use.
Yeah. And if we, connect this back to the bigger picture, this whole deep dive really shows just how incredibly meticulous Shariah compliant investing is.
Really does.
It's not just, avoid alcohol companies. It's getting right into the weeds of revenue streams, debt structure, even what happens with dividends afterwards.
Mm-hmm.
What it provides at the end of the day is a clear path for investors who want their financial decisions to line up with their faith. It gives peace of mind and very specific, structured guidance.
So what does this all mean for you listening, whether you're an investor yourself or just curious about different ways of thinking about finance?
It really highlights the sheer complexity, the rigor
Definitely.
that goes into Shariah screening. It's a level of detail you don't always see elsewhere. It shows how deeply integrated faith can be in financial choices. Absolutely. And maybe a final thought to leave you with. Consider how these very specific, detailed screening rules might shape the kinds of companies that actually do well in the Shariah-compliant investment world.
Interesting point.
What could that mean for innovation or for business models within that whole economic sphere? And maybe also think about what other ethical or values-based investment frameworks are out there. How do they stack up against this kind of detailed, principled approach? Something to mull over until our next deep dive.